Good morning/afternoon, everyone. I'm excited to discuss with you today the comprehensive assessment of revenue risks in auditing. We'll be focusing on evaluating both inherent and control risks and exploring how understanding these can significantly enhance the effectiveness of our audit processes. This is a crucial topic for ensuring accuracy and reliability in financial reporting, and I look forward to sharing insights that will help us better manage and mitigate these risks. When we talk about inherent risk in revenue, we're referring to the chance that there's a significant error or misstatement in the financial records even before we look at any controls the company has in place. This risk comes from several sources, including areas where management has to make subjective judgments, transactions that are complex, and unfortunately, the possibility of fraud. Revenue is especially vulnerable because common problems like recognizing revenue too early or even recording fictitious sales can easily occur. These issues make revenue one of the most critical areas auditors need to carefully examine. For auditors, the key is to zero in on parts of the process that involve a lot of judgment by management or complicated transactions. By doing so, they can better detect where inherent risks might exist in revenue reporting. Control risk in revenue refers to the chance that the internal controls set up to manage revenue processes might not catch or prevent significant errors or misstatements quickly enough. This risk hinges largely on how well these controls are designed and whether they are consistently applied in practice. Key controls that affect this risk include those governing authorization, recording, and monitoring of revenue transactions. These are crucial because they ensure transactions are legitimate and accurately recorded. Finally, the level of control risk we identify directly impacts how much auditors can rely on these controls when assessing the financial statements. If control risk is high, auditors will need to perform more substantive testing to obtain sufficient evidence. When assessing inherent risk for revenue, there are several important methods to consider. First, we look at the complexity of the revenue cycle and the variety of transaction types involved. A more complex cycle increases the likelihood of errors or misstatements. Next, we examine historical audit data, including past findings, financial restatements, and any previously identified misstatements. This helps us understand areas where risks have materialized before. We also analyze external influences like industry trends, economic conditions, and changes in regulations, all of which can impact revenue risk. Additionally, it's important to evaluate contractual terms and be aware of any potential earnings management practices that could affect the reported revenue. Lastly, we apply analytical procedures to detect unusual fluctuations or anomalies in revenue data, which might signal higher inherent risk. Together, these methods provide a comprehensive approach to identifying and understanding revenue risks. When assessing control risk for revenue, there are several key methods we use. First, we review the documentation that outlines the company's revenue control activities and policies. This helps us understand what controls are supposed to be in place. Next, we test both the design and the operating effectiveness of these controls to ensure they actually work as intended in real transactions. Another important aspect is assessing the IT system controls, since many revenue processes rely on technology to record and process transactions accurately. We also conduct inquiries with management and staff to gather insights on how well the control policies are being followed in day-to-day operations. Finally, we examine reports on control deficiencies, including findings from internal audits or external sources, to identify any weaknesses that might increase the risk of errors or fraud in revenue reporting. Together, these methods provide a comprehensive picture of control risk related to revenue. Here, we start by integrating the inherent risk assessment with the evaluation of control risks to get a full picture of the potential risks involved. Next, we classify these risks using a risk matrix or rating system, which helps us understand both the severity and likelihood of each risk. Once we have this classification, we determine the overall risk of material misstatement specifically in revenue, based on these combined assessments. This allows us to tailor our audit procedures, the nature, timing, and extent, so they are targeted and effective in addressing the risks identified. Finally, it's important to remember that risk assessments are not static. We continuously update them throughout the audit as new information emerges or conditions change, ensuring our approach remains relevant and responsive. When assessing revenue risk, it's important to remember that revenue is inherently a high-risk area in audits, mainly because it's susceptible to fraud and involves a lot of estimation uncertainties. To effectively manage this, we need to perform risk assessments in two distinct parts, first analyzing the inherent risks, then evaluating the control risks, and only after that do we integrate these findings for a complete picture. Utilizing data analytics tools can be a game changer here, as they help us spot unusual or inconsistent revenue patterns that might otherwise go unnoticed. Thorough documentation is also crucial. Every risk assessment should be well supported with objective evidence to ensure transparency and reliability. Communication shouldn't be overlooked either. Maintaining an open line between audit teams and company management about control issues helps address problems promptly. Lastly, using checklists is a simple but effective way to guarantee that all relevant risk factors are considered and to make periodic reassessments more manageable. These practices together help us navigate the complexities of revenue risk assessment with greater confidence.